Day morning. My name is Dhanashri, and on behalf of IIT Alumni Association of Southern California, I welcome you to the event Get Smart About Valuation. Now, before we even dive in, I would really like to thank Abhi and Ravi for taking this initiative and putting together this event. They have we all love their enthusiasm and the effort that they have put in, and I think you will see the value if you stick until the end. Now, before we start, this event is presented to you by IIT Alumni Association of Southern California. We are a strong community of 3,000 plus alumni from 23 IIT, and we are still growing exponentially, actually. And we have been extremely busy in creating a full busy calendar of events that you will love. Um, Here is a snapshot of our upcoming events. So on April 26, 2025, we have an in-person career building workshop type of event called Innovate Your Career. Innovate Your Career. It's going to be in Irvine. The details will be shared in all the channels that you are in, but it is mostly for professionals to understand how to network, how to grow your network, how to climb up the professional ladder. And after that, we have the summer picnic on June 7, 2025. It's like we are planning to have a day of relaxation with a lot of fun activities for all the age groups. So it's just a get together in a beautiful sunny garden. And yeah, before that, I would just like to go through the house rules. So the first thing is that we will be recording this entire video and we will be publishing it on our social media handles. We request everybody, apart from the speakers, to stay muted during the presentation. However, we encourage you to, ask the questions in the chat. You can ask it in the chat or in the Q&A session, whatever is favorable to you. And at the end of the session, Ravi and Abhi will address all of your questions. We might ask you to unmute yourself to ask your question to add additional, clarity or add clarity to the question. So just be available. Yeah, apart from that, you can scan the QR code to join our community via LinkedIn and on WhatsApp. Now, um, before I start, I just wanted to mention that, we are really enthusiastic bunch of people who have diverse skill sets. And being part of the community gives you an ability to communicate and connect with these people who are otherwise, far out of reach. Like, for example, right now, it's a turbulent market. I don't think that's a news to anybody. But, tackling questions like, should I invest? Is it a good time to switch to this particular company? Or, how should I think about my personal wealth? Are some of the questions that are on top of our minds. Now, there are two ways to go about it. You can spend all of your time researching about it. That's a good way. But you could also tune into this particular session where experts like Ravi and Abhi are channeling their expertise and giving us a head start. Now, before we start, I would really like to understand, what prompted you to, join in and tune in this session. Just gives us a better idea, and it gives us a better idea of, what your expectations are. So I'm just gonna, start a poll. Would love to, hear what prompted you to, attend today's webinar. Can you guys see the poll, right?
I don't see the option. Okay.
Yeah, Priyank, you're the host. You can't.
I can see it.
Wow, we are going heavy on the two options.
Yep.
I was hoping the last one will be the favorite one. Dang, I'm upset now.
All right, so I'll just share the results. I hope you guys can see the breakdown of the choices. I think it's good that, Abhi and Ravi, I think you know what to focus on more. Yeah.
Absolutely. And I think it's great that a lot of the audience is here to really learn a little bit more about enterprise valuation itself and the nuances thereof and the drivers and so on, which we're going to be addressing. And also a portion of the audience that already has um, a foundation in an understanding of valuation and are here to really sort of validate their knowledge and their understanding. So both are really strong reasons to be at this webinar. Thank you, everybody. Appreciate it.
Awesome.
Is this meeting being recorded?
Yes.
And we will be given the recording, right?
Yes.
Okay, wonderful. Thank you.
Yeah, no worries. Yeah. So without further ado, I will love to introduce both our speakers. So the first in line, Abhi Mukherjee. He is alumnus of IIT Varanasi, operating partner at Caracap Ventures, and a venture capitalist for over 27 years. And he has led innovation initiatives worth 1.2 billion across, global companies. So great to have you here, Abhi.
Thank you.
Yeah. Moving on to Ravi. Ravi is alumnus of IIT Madras. He's currently the managing director at Allied Advisors, a deal-making expert with over 20 years of experience and managing over 6 billion in deal transactions, specializing in tech and telecom mergers and acquisitions. Really great to have you here too, Ravi. So
Thanks for the opportunity.
they are the most energetic and knowledgeable bunch I've ever met. So I think I'll hand over the stage to you. Over to you.
Thank you. And I'm going to start showing my slides here, our slides. Okay. Can everybody see this?
Wonderful,
Yes.
wonderful.
Absolutely.
Well, thank you everyone for this opportunity to Ravi and I. We met, I would say a couple of months back, and we started discussing about how to kind of make something which is at times a dreaded topic and very boring and monotonous, how to kind of create excitement about it. And more than that, it was all about kind of creating some kind of awareness. But before we say anything, this is our disclaimer. Please take a moment to read it very carefully. Nah, I'm just kidding. What it really means is that nothing that has been shared here, in a sense, can be construed as an investment advice. What we are trying to kind of do here is kind of share our anecdotal experience. It's really kind of our personal observations and what we see from our perspective, from our lens, what this means. Apart from this disclaimer, there is another disclosure. The photo of Ravi that you see, that's how the conversation started. Who you see today is as an outcome of preparation for the webinar. He has aged a bit, so my apologies to Ravi on that account.
Thank you for that, Avi. I appreciate that. Dhanushri, I think you can start the second poll.
Yes.
Wonderful. Well, this poll is going to be very, very critical because I would encourage each of you to kind of go ahead and participate in this, just to know that you are awake. And thank you so much for joining us. If you're joining from really India or the other side of the globe. While it's really kind of morning out here and sunny in sunny Southern California. And thank you so much for joining wherever you are from. Good morning, good afternoon, or good evening for that matter. So I see most of you have responded. So over to you, Ravi.
Yep, thank you. And looks like the first test in the semester has been passed with flying colors. That's a really good response, by the way. And all of the above is the right answer. So let me get right into what we're talking about when we mean enterprise valuation, right? So in the spirit of an IIT education, we thought we should start with an equation. But fortunately, it's the only equation in the presentation, so you guys can rest a little bit. So why is enterprise value or enterprise valuation so important, right? It's a very fundamental question. Think of it as it's what a business is ultimately measured by when the company is sold. So shareholders need to keep their eyes on this prize at all times, whether you're a startup or you're a mid-stage company or you're a late-stage company. Always keep your eyes on the enterprise value, because that's really the pot of gold at the end of the rainbow when you sell the company, right? How exactly is it defined? Enterprise value is the sum of the equity value of a company. Equity value is sometimes also called market cap when the company is publicly traded. And that's the equity value, plus the debt of the company, less the cash holdings of the company. So think of it as what an acquirer, a buyer of a business, has to pay to acquire the business. It's the value of the equity, which is the value of the shares, and the value of the debt that is being assumed by the buyer, offset by the amount of cash, since the cash benefits the acquirer. So that is the definition of enterprise value. And because of the way it includes everything, it captures the entire capital structure of the company, the equity, debt, and the cash, and is hence the true economic value of a business, from many standpoints. So that is the definition of enterprise value. So Abhi, now that we know how enterprise value is defined, can you tell us a little bit about what the key drivers are of valuation?
Absolutely. And before we head there, and just to kind of reiterate, as Ravi indicated, that enterprise valuation is the process of determining the economic worth of a company, which can be considered as a cornerstone for a wide range of stakeholders, whether it's for the investors who are seeking informed decisions, or for the financial professionals or organizations guiding strategic direction, maybe entrepreneurs charting growth, and corporate executives overseeing performance. So you see, a topic of enterprise valuation, although not in the talks, it needs to be the very core part of the DNA of any company from day one. Historically, business valuation has been primarily relied on three fundamental approaches, which has been based on income, market, and asset-based approach. But valuation in itself is not a precise science. It's an art that involves making some assumptions, some judgments about future performance, market conditions, and other factors that can really influence the value. And valuation is subjective. It's inherently subjective, meaning it involves a degree of judgment and interpretation rather than solely based on objective data, or different individuals or entities may assign different varying values to the same asset or company, even though they are using a framework to making these assessments. The subjective judgments and interpretations are thereby very, very necessary. Now, while thinking about what would really kind of be important to understand the core tenets or the fundamentals of evaluation, it's very important to kind of see it in terms of the value system. Now, this is something that I was talking to you about anecdotal experience. It's based on my perspective that how you would go about considering the value of a company. VALUE, where V stands for validation, A for affiliation, L for leadership, U as in USP, and which is unique selling proposition, or what's really kind of makes you that unique, and E as earnings. Within the validation, what we are looking for is the product market fit, the customer loyalty, and more like an ICP, the ideal customer profile, that gives you and your business model the very much needed validation in terms of whether this is something that can be sustainable. Does it have enough teeth to be able to kind of grow and expand? While affiliation is something that who are those who are marching alongside you? Who are the partners, the advisors? It really represents the brand equity. Who stands with you? Who are this team? Because at the end, the teamwork makes the dream work. In terms of the leadership, the C-levels, the people who are going to be like kind of taking this to the next level, which is beyond the validation and the affiliation, the ecosystem that we have developed, it's the team leaders, the regional heads. It's the leadership that's kind of thinking about the growth trajectory strategically. They're talking about innovation on a daily basis. Who is this team? Because they are the ones who are going to take this company to newer heights. Going back to the USP, as I was saying, it's the element of differentiation. It's that innovation aspect of it, which is really the objective way of looking at what is your moat. Why would your business model would survive? Why it is so critical? Do you have a IP? In terms of patent, trademark, copyright, trade secret. It's those assets that's really kind of creating that moat around you that you cannot be disrupted that easy. And disruption can be within or it can be outside. But this is the USP, the core fundamental perspective that's really kind of help you survive the test of time. Earnings, there are many ways to kind of dissect this. In terms of when you look at earnings, there are these different revenue model, how you're going to be like charging. Is it going to subscription based? And what are the different elements of this subscription base? EBITDA. Well, while Ravi calls EBITDA as earnings before interest, taxes, depreciation, and amortization, I fondly call EBITDA as everybody ignores this damn acronym. Well, the formulation of EBITDA is usually attributed to John Malone, the billionaire, builder of a cable television empire back in 1970. And he thought there has to be metric that kind of infuses not just the element of operating income, which is a derivative of gross profit minus operating expenses, but also adds the element of depreciation and amortization. But the other element that we as investors also kind of look for is the cash flow, the true marker of how the money is flowing in and out of a company. So if you really see, if one core takeaway from today's session, I would say, based on our learnings from what we have seen so far in terms of deriving valuation, it's the value system that is very, very critical to define the intrinsic value. These are some of the internal values that are within your reach. Over to you, Ravi.
Thanks, Abhi. And we're going to be talking a little bit more about specific metrics and the levels that drive low valuations and high valuations further in this presentation, a little bit later in the presentation. So that's a little bit of a deeper dive. But so what Abhi has captured here, incredibly important. These are factors that a business can inherently control. These are factors internal to a business. These are factors that can be influenced by the management team or shareholders. But as we have seen in recent times, there are many factors that are outside, external, exogenous to a business that substantially, materially impact valuation. Let's talk about that. Here you go. So what's going on here is these are the various external factors at a pretty high level that impact enterprise valuation. The first one is probably most topical and top of mind for most people here today, which is regulatory. It's important to note that regulation by itself is not a bad thing, since companies can invest in becoming compliant with that regulation. And in fact, you can get differentiation and build moats by being compliant with certain kinds of regulations in industries, like healthcare, for example, and financial services and telecom and so on and so forth. But it's the change in regulation that creates uncertainty and adversely impacts business valuation at the end of the day. It's the change in regulation. The biggest of which we have seen recently, which are the trade tariffs that have been imposed by the current administration. And the trade tariffs have absolutely ravaged the market. We've seen the markets lose about $2.5 trillion over the last couple to 3 days. And our 401k looks like a 201k these days. There's fears of recession. There's fears of inflation because of tariffs and the higher costs being passed on to consumers and so on and so forth. So there's significant fears around what the tariffs are going to do, and you've seen the impact on enterprise valuations of companies across most sectors in the economy. And that sort of is a good segue into the market economic factors. We just touched upon economic growth potentially being impacted by the tariffs and other factors currently in the economy, and inflation could potentially be a risk, with increasing prices if companies which are facing higher tariffs, higher supply chain costs, start to push that along to their users and their consumers. You're going to see inflation in the economy, and that's going to depress spending, and that's a bad thing for the economy overall. The third major factor is political. Certainly, I don't want to dwell too much on this, but you're seeing some of the policies being implemented, whether this administration or the prior administration, and it is starting to impact employment in specific sectors like the federal sector and so on and so forth. There are also other disruptive factors which large part of this audience are probably very familiar with and have experienced themselves. And let's talk about the innovation index for a second. The innovation index is a measure of how quickly innovation in a particular country or region is really growing. And the conventional wisdom is that if your business is not innovating as fast as the innovation index, you're not going to survive for very long. So that's something that I think business owners, shareholders need to keep in mind. The second big factor there is the impact of emerging technologies, which can disrupt not just your business, but entire industries. And we'll talk about case studies that are specific to how this has happened in certain industries. Everybody's also familiar with cybersecurity risks. The attacks, the cyber attacks on companies. We saw that with Experian, with Verizon. Large companies can be very adversely impacted, and small companies with limited resources can be put out of business as a result of cybersecurity attacks. Another one is key man risk. And what key man risk is, there's going to be like 1 or 2 or 3 people in a business that are critical to not just the success of the business, but even the existence of that business. For example, Steve Jobs in the 1990s was let go from Apple. And as a result, Apple almost went bankrupt during that period. And then they had to bring Steve Jobs back to revive the company. And it is like the most valuable company in the world today. So key man risk is something that's extremely important. And there's a concept of business continuity as well, and having the right systems, the governance, and the infrastructure to ensure that in the event of significant unanticipated disruption, that the business can still continue. And last but not the least, for sure, are black swan events, which are the Six Sigma events, the horrible ones like pandemics hitting and wars happening and natural disasters and so on and so forth. And that can have such a dramatic impact on businesses and the valuation thereof. So these are the broadly high-level external factors. And Abhi, do you want to add anything to this, or shall we get right into the case studies?
Well, thank you so much for kind of overarching summary on the external factors. While the previous slide was talking about the intrinsic aspect of it, this is more like an extrinsic systemic value, because at the end of the day, from fundamentally looking into the value of a company or an asset, it's the combination. The final value is derived from both intrinsic and extrinsic value. And these external factors, while some of them, while one may also kind of say that, well, a key man risk. What if, the person is really not happy and decides to kind of part way with the enterprise? How do you really kind of view it as an external factor? There are ways of looking at it from a different pair of lens. When we say the key man risk, at times there has been instance wherein the entire leadership was actually traveling in a private jet, which unfortunately met with an accident, and the company lost all their executives in just a blip. So that is more like an external factor that is beyond your control. It is very well known that at times people are being poached by their competitors. So those are something that is really kind of external to it. So you are not immune as an entity to kind of really be able to kind of look at that specific element wherein however hard you may try to retain them, to kind of give them all kind of necessary training, create that camaraderie, create that culture, there are those external factors that might impact your key man. And that's why this particular element becomes very, very important. Other than that, of course, I would say that it's very important to kind of see how this external and internal parameters have truly impacted the some of the other like kind of companies. So moving on to the world of some case studies that we would want to kind of share with you today. And the first one, while there are so many examples, so many of them, so we wanted to kind of pick some that will resonate with you and dissect it. All right, I think we need to mute. Probably 1 second. Thank you. So one quick request, if you can just please mute yourself when you're joining or during the course of the webinar, will be greatly appreciated. Going back, so we were talking about the Netflix versus Blockbuster. It's such a bizarre name, Blockbuster, and then I just focus in the central theme, which is bust. Business going bust in the Blockbuster. And it is so bizarre that Blockbuster that was established in 1985, while Netflix, which was 12 years later, if you really kind of look at the aspect, you would really expect that, Netflix is really trying to mimic what Blockbuster have done really fairly well. So why even really kind of bother about the kind of business model? Why to get into a particular arena which has been already kind of taken over by a giant called Blockbuster? But at the end of day, what if you really look into the context of why Netflix survived versus Blockbuster failed, it actually boils down to 3 specific elements, which is first, embracing digital transformation. Second, a customer-centric approach. And third is really the critical one, which we just discussed, innovation and adaptability. So let's talk briefly about these 3 aspects. Embracing digital transformation. Netflix recognized the potential of streaming and actively invested in technology to deliver content online. Blockbuster, on the other hand, it was so slow. It was too slow to adapt to digital trends and remained heavily invested in its outdated brick and mortar model. And that's the reason as to the speed to innovation within and speed to embracing digital transformation. Really, you know that Netflix is one of those coveted, even the shares and their market cap, and a very, very valuable company, while Blockbuster had to file for bankruptcy. The customer-centric approach is where Netflix prioritizes customer satisfaction by eliminating late fees and offering convenient on-demand streaming by going into subscription model. You get to keep the DVDs as much for time you want. We are not going to penalize you. However, Blockbuster's late fee structure was a source for frustration for customers and eventually driving them to competitors like Netflix. If you don't take care of your customers, someone else will. So that's where really blockbusters saw the decline in their revenue source, which was really based on something which really was the reason for frustration for the customers. Last but not the least, the innovation and adaptability. Netflix continuously innovated and evolved, moving from DVD rentals to streaming and then eventually creating its own original content. It's now a mogul when it comes to creating its own original content. While Blockbuster's reluctance to adapt to evolving customer behavior, the latest industry trends hindered its growth and ultimately led to his downfall. Now, this is a very good example, and you would feel that, well, you know what, people would have learned from this. But no, in 2002, there was this another company that was founded by Greg Kaplan, Redbox. And we know what happened to that. Redbox thought, okay, let me not go with a brick and mortar, but have a dependency on brick and mortar and maybe kind of have those kiosks that is going to give you the DVDs. But again, with the advent of Netflix, Hulu, and later on joined by Disney, Paramount, and all of those streaming services, Redbox met with the same fate. And also later on, they decided to get into Redbox on demand, but at the end of day, they have not only to kind of end up filing Chapter 11 bankruptcy, but also it was converted into Chapter 7 liquidation due to all the money that they could not pay back to the studios. So it's all kind of, comes down to perform or perish. Actually, this is a very good case study because one of my mentors used to tell me, you know what, listen and silent, these two words are anagram. With the same choice of alphabets, you can say listen as well as silent. So you can only listen when you are silent. Just try to kind of absorb what around you. That will be a great factor for you to understand what is working, what is not working, what your customer is telling you, so that you can adapt. Otherwise, you perish.
Thank you, Abhi, for that. Let's talk about one that is also quite revolutionary in some sense, right? So the auto industry had operated for over a century with very few changes, with incremental changes, maybe product design and this and that, since the advent of the Ford Model T, which was in the early 1900s. Tesla came around literally just 2 decades ago and disrupted the entire industry with what is widely recognized to be the first modern electric car, with the most advanced software on the market. And it has never lost its innovative edge. Not only that, Tesla also pioneered a direct-to-consumer sales model, whereby expensive dealership franchises and things like that could be avoided. And the software was so cutting edge that its competitors, primarily Ford and GM in the US market, struggled to keep up with the wave of demand that shifted from traditional gas-powered cars to electric vehicles. And Tesla greatly benefited from it as a result of the shift in consumer demand. And if you recollect, uh, one of the external factors that impact valuation is consumer preferences, consumer trends, and that changed dramatically. Tesla created a market for EVs, just like Apple created a market for iPhones. It was a dramatic shift in consumer sentiment. And the proof of the pudding is in the eating, as they say, right? So if you look at some numbers here, Tesla has half the revenues of Ford and GM, if you look at this table, right? But Tesla is right now valued at over 5 times Ford and GM, which is absolutely remarkable. Tesla trades like a software company, and it's no wonder that people call their cars software on wheels, right? So if you look at the ratio of enterprise value to revenue, Tesla is at 8.3 times right now, which is staggering if you think about it. and Ford and GM are trading at less than 1x revenue. But all said and done, Tesla, even a company like Tesla, is not immune to external factors, right? And its value has fallen by probably over $500 billion, probably more in the last couple of days, due to the political actions of its founder. And as a result of the political actions, the sales globally have been impacted, and the recent results show that um, Tesla shipped out quite a few fewer vehicles than was estimated by analysts, and its stock has taken a beating. So no company, regardless of size and strength, are really immune from external factors. So Abhi, over back to you, and Abhi's going to make the conversation a little bit more colorful. So go for it, Abhi.
Wonderful. Well, while the slide says it's a valuation journey, I call it the slide that has whipped your, the color of the rainbow. As you can see, what happened here, Ravi? I don't see actually some colors here. They're missing. Is that because of the color that represents Theranos?
Yes, that was green, and unfortunately, green faded into the background. So
So you would say that there are different companies, they hold kind of different value. And Ravi and I were thinking it would be very interesting kind of these are not exact plots, but just to kind of give you an idea and sense in terms of in time, if you kind of keep on improving your currency, and you know how to kind of deal with these internal factors and external factors, you will be kind of going through a transformation. And if you can survive through that transformation, you emerge as a winner. And if you are not able to kind of pace up with the transformation or the innovation, remember Jack Welch said, right? The rate of change, if it internal rate of change exceeds, or if it does not exceed the external rate of change, not in those choice of words, but the end is near, meaning you have to innovate yourself. The change you have to embrace change, because there's only one thing that is a common theme and constant theme for all the companies that are doing good, which is adapting to the change. And Apple, while it had its own, if you really look at the graph of Apple, is like kind of the ups and downs. But when iPod came in, and then iPhone, and Steve Jobs was brought back in, we saw exponential growth in terms of how iPod, iPad, iPhone was embraced, because they kind of changed in terms of the mentality and to kind of resonating, not just like, hey, what we do and how we do it. They started their marketing philosophy on why we are doing it. And it kind of changed everything. But after his demise, and looking at Apple now, it has a very, very incremental growth, if you really see, mostly mimicking what Samsung has been doing, and then trying to kind of catching up to speed, and not really kind of doing something which was really disruptive in true sense that Steve Jobs did. Nvidia, on the other hand, was really kind of having a steady growth. But one fine day, look at the stock. They just like kind of blew up, and the market cap is phenomenal, because they just wanted to ensure that they are in sync with the market, and look what lies ahead. The investment is not about today, but looking into the forward, and then see the future of computing, the future of AI, and then how to kind of be relevant. On the other hand, Intel, it's just flat, doing everything that they can. They are now having a reshuffle in their leadership, but still it has been a flat. It was doing so well. But again, they need to catch up. On the other hand, Facebook, aka Meta, they have had their own kind of metaverse versus dabbling into this and that. There were so many ups and downs at times, kind of acquiring assets and then trying to kind of really kind of having organic versus inorganic growth. So their journey has been, it's really with ups and downs, but it's really that constant kind of change that has survived them through all this topsy and turvy. But WeWork, Oh my. At one point in time, they were like the blue-eyed boy, the baby for SoftBank and whatnot. And the paradigm changed, and they did not know how to kind of cater to the emerging paradigm when people went back to their home and working remotely, and no one really wanted that space at time. Their business model was not really kind of fit to scale. And plus, there were others who were mimicking their model. They also kind of started fading into oblivion. So these are indicative of there are so many things. It's a combination of the internal and the external parameters that really kind of make or break in terms of your existence. Ravi, would you like to add some perspective into it?
Yeah, and fraud is bad. You saw what happened to Enron. Saw what happened. WeWork. And so those are the internal factors. But as Abhi alluded to, I think one of the greatest stories in the recent sort of, I would say, last couple of decades is really that of NVIDIA, um, with Jensen Huang sort of, you know, starting the company and starting off potentially not on the in the right strategic direction, but then having the vision and the foresight to see where the AI market was headed, and then switching and pivoting the business entirely almost to producing the phenomenal GPUs for to keep pace with the expansion, the explosion in the AI industry, and that has absolutely transformed that business. So these are all sort of these companies are just like great examples of how they've adapted or not adapted, and it's just a cautionary tale in a lot of words, for the ones that are at the bottom of this chart or not on this chart. So it's time now for a midterm exam. There you go, poll number 3.
Well,
Yeah, now we're going to get some.
interesting response, I'm very sure. Because now what we have done is we have started with the really kind of the easy ones, and then we were like kind of thinking, how do we like up the ante, and then see how our audience are going to react to it. And it was very refreshing to see, Ravi, that we have really an amazing crowd here, those who wanted to understand the nuances and who were coming to kind of get a validation of what they know. And it was really kind of an august company that we are having this webinar. So thank you again, once again, to everyone who are taking time out of your Saturday, or maybe it's Sunday early morning for some of you. Truly appreciate you giving us the time and opportunity to share a perspective. Really appreciate that.
Give it a few more seconds, and I
Few more
think
seconds.
we're probably close to being done. Okay, so interesting results. Interesting that the second and third responses are tied, and the quote unquote the right answer is really the third one. When you talk about synergies, you're usually referring to the financial uptake that can happen as a result of an acquisition. So, and that financial uptake could potentially be, rationalization of certain groups within an organization, like the CFO's office or the marketing office or back office and IT and so on and so forth. When one company acquires another, those are some of the typical cost synergies. But as importantly are the revenue synergies. When one company acquires another, usually the key driver for the acquiring company is, how is this target company going to help me improve my sales? Do we have a customer base in the target company that I can sell my products into? And and do we have a customer base that the target company can sell its products into? And the combination of the sales force being effective and so on and so forth. So there's synergies in the top line, there's synergies in the bottom line, and what that helps is to build a better internal business case for the buyer, which can translate into a better enterprise valuation that is offered by the buyers in a M&A transaction, which can actually bridge the gap between the expectations of the seller and the buyer. That's really what makes these transactions work at the end of the day. So synergies are extremely important. Understanding synergies, developing what the synergies are, and building a business case around them are extremely important things that in an M&A transaction. Okay, moving on. All right, so we did tell you earlier that we're going to be taking a little bit of a deeper dive into what are the sort of the key elements of that impact factors that impact valuation, and these are the financial metrics, if you will, right? And the low is the low end of enterprise valuation, and high is the higher end of enterprise valuation. Very scientific, of course. So some of the most important value drivers, valuation metrics that a company needs to keep in mind are the market size. Market size is also the market opportunity, also called TAM, total addressable market. And that is extremely important because if your business is addressing $100 million TAM versus $100 billion TAM, the buyer or the investor is going to view your business very differently. The scalability of a business really depends upon the market size, how much you can grow into that market. And that's one of the reasons why AI companies, cybersecurity companies, and healthcare companies, and so on, enjoy the valuations that they do, because the sky is the limit for these businesses. All right. So market size is extremely important. So is revenue growth. Everybody talks about software companies growing at 30, 40, 50%, and some of the old world companies, utilities, and sort of growing flat or 2, 3, 5% a year. That actually translates into multiples, your valuation multiples, right? Software companies have traditionally enjoyed the highest revenue multiples amongst any other sectors, and that's for the reason, because software companies grow really fast, right? But revenue growth cannot be it cannot be growth at all cost, right? It has to be balanced with ultimately with profitability and cash flows at the end of the day. There was a period of time in the boom era, 2021 example, 2016, 2017, the boom eras for the market, when everybody just talked about growth, growth at all cost, and growth forgives all sins. Yeah, to some extent, growth does forgive all sins. But at the end of the day, when cash is tight, and the market is slowing down, you need to have profitability. You need to have cash flow to sustain the business and to keep the value of the business sustainable. And so balance it out with good gross margins, good operating margins, and so on and so forth. And these are some of the levels that drive either a low valuation or a high valuation. We'd also touched upon the revenue model earlier. So non-recurring revenue models, like the ones that you find, for example, project-based revenue models, where you charge for a project or based on time and materials and so on. Those are less likely to attract high valuation multiples, but contracted recurring revenue models like SaaS subscription models or managed services subscription models, those kind of revenue models are more likely to be valued highly, just because there is visibility, there's dependency, and there's robustness to the revenue streams, and that obviously translates into a more favorable perspective of the sustainability of the top line. Client concentration is one that a lot of people sort of sometimes ignore, and it's also typical that early stage companies, in the sort of the seed stage or post seed stage, pre-series A, they tend to have customer concentration just because the business was built on a relationship with one or two or three customers that the founder may have had relationships in the past that he or she leveraged. So it's fairly typical that there is some amount of customer concentration in early stage companies. But once you start getting into higher revenues, it's essential that the revenue base be diversified across a large number of clients. And these numbers sort of represent how buyers and investors think about customer concentration. If you do have customer concentration, you're likely to get a haircut in valuation because of the perceived risk of the loss of the key customers. If one or two customers are generating 50% or 60% of your business, that's a major risk if those customers go away, and it could crater the business. So that's something that business owners need to keep in mind. Of course, the team strength, I think we've talked about that. No need to harp on it any further. Just to know, just going back to the free quote unquote free report that is going to be sent to all the participants here. That's going to be deep diving into some of these factors and give you a much better analysis on how and why these factors impact valuation. So it's more of a sort of a rigorous quantitative analysis. All right, back to here. So this is a quick look at the trends in the marketplace, right, over the last few years, right? So what these numbers represent, the pre-bubble 7.0, during the 17.4 and so on, these are the enterprise value to revenue ratios for various indices, right? And this one represents the one for what's called the BVP index, cloud index, which is maintained by a large VC fund called Bessemer Venture Partners. And it's a very popular index because it constitutes some of the leading lights in the cloud software space, including the likes of Snowflake and Datadog and ServiceNow and other companies that are driving digital transformation, and is sort of representative of the new generation of tech companies, if you will, as compared to the more conventional indices of the S&P 500, which is in the red here, and the NASDAQ, which is in the yellow here. And the key takeaway from this little bit of an eye chart here is how tech valuations have changed. And if you look at what we call the pre-bubble, this area here in late 2021 to late 2022 is sort of the bubble area. Prior to that, we had a bit of COVID going on, so there was sort of a dip in everything pretty much. And the valuations were about 7x for the BVP index. But come 2021, there was a perfect storm of close to zero interest rates, easy money, an oversupply of capital, and also an overhang from COVID with a lot of sellers coming to market, a lot of buyers coming back to market, trying to get transactions done, and that really drove up the valuations to some pretty bubbly levels, like on average it was like 17.4. So that is sort of considered to be the recent bubble era. Since then, the Fed embarked on a tightening policy. Interest rates went up to control inflation, and you saw a nosedive of tech companies since then. And right now, the BVP index is at about 7.8 times revenue, which is not bad considering things, but nowhere near the bubble, if you will, right? So we're going to see these roller coasters, and certainly if we're going to see another era of low interest rates, 1-2% type Fed rates, then you can expect that there's going to be continued escalations in the valuation of especially tech businesses. There's a very fundamental reason for that, they're going to get into separately. But tech companies typically tend to be quite sensitive to interest rates. So that said, let's do the final exam, Dhanashree. The last,
Yeah, one
poll.
second. Just
Yeah.
turning it.
And while we are doing that, just wanted to kind of quickly acknowledge the WhatsApp University that I got a message yesterday on WhatsApp University. It says that the next recession is confirmed, and citing these recessions happen almost every 100 years. The first one by President Jackson, then President Hoover, and now President Trump. Well, the experts of the WhatsApp University forgot that it was not because of tariffs the first two recessions happened. There are other factors as to why the recession happened as a result of actions by President Andrew Jackson and President Herbert Hoover. So yes, at times what you see, you should not believe, and probably you need to have your own due diligence and then get to the core rather than just believing in the WhatsApp University. Just wanted to highlight that. All right, I think we have enough responses, and looking at the time, probably we can just end the poll. And
the right response is, in fact, the second one, and Abhi is going to talk a little bit about the different valuation methodologies. So Abhi, take it away on this one.
Wonderful. Well, looking at this, and I believe there was a question as I was monitoring the chat, there was a question about, valuation is in the eyes of the beholder. And this is more like not the complete set, but just a kind of a very like a targeted set of different valuation methodologies that are being used in terms of kind of arriving at the different facets of how do we value a company. It can be based on the public comparables or the M&A comparables, discounted cash flow, or the accretion dilution model. At times, 409A valuation becomes very critical for investors from the venture capital community because it helps us look at the fair stock option value, fair market value, FMV, and then kind of help us kind of guide for the next round of funding. And at the end of day, valuation is something that is not spoken in the private market on a daily basis. Please understand this. But that is kind of a silent beast. If not tamed well, it might come and really kind of haunt you in a nightmare. So from a private market standpoint, doesn't matter which valuation methodology you would like to pick up, the fact remains that mostly it becomes important at the time of maybe a liquidation event, M&A, going IPO, a specific kind of event horizon of when you are having an equity round, or maybe more importantly, during the annual audits. It is very important to understand where your portfolio companies stand and be able to kind of include that as part of your financial statements. So there are many ways to kind of go about it. This is just a kind of a quick snapshot of it. And Ravi, do you want to also capture some of the elements of what you see as an investment banker, and what are some of your favorite ones from this list?
Absolutely. Thank you for that, Abhi. And as a practitioner, M&A practitioner for over 20 years, one of the things that has become very obvious and certainly true to today is that companies are valued based on what the market largely looks like, and which means that you really have to look at what similar public comparable companies are trading at in terms of their multiples, what some of the M&A deals have happened in the marketplace, and the multiples that the the selling company have obtained in those M&A transactions, and so on. So as a practitioner, I can tell you that M&A comparables and public comparables are most frequently used for valuing, especially private companies, right? The discounted cash flow method is one that is one that sort of dominates the conversations at MBA schools, right? And for associates and analysts, right? And it's an approach that projects out the company's P&L and cash flows, and then discounts it back to present value based on what is the industry terminology for it is called WACC, W-A-C-C, weighted average cost of capital. We call it wacky because honestly, the WACC is something that you can't really pin down, and it's in the eye of the beholder. And if you change back even by 1% or 2%, it sometimes dramatically impacts the value of a company, especially in a high growth company. And that's also one of the reasons why tech companies are pretty sensitive to interest rates, because tech companies' valuations are often predicated on high growth, right? Revenue growing fast, EBITDA, cash flows growing really fast. So if you go around and change the discount factors for DCF, you'll see that there's actually a fairly dramatic impact for tech companies, and that's why inflationary periods in the economy have a dramatic impact on tech companies. So do like the economic slowdown, because again, it slows the top line down. So, just wanted to, before we close out here, just wanted to share with you a couple of examples. This is an example of a public comps analysis where we've looked at some companies, some of the leading companies in the healthcare technology space, and what you see here are the various financial metrics, and at the end of the day, the last two columns are probably the most important. The revenue ratios, enterprise value to revenue ratios, and the enterprise value to EBITDA ratios, right? And we look at sort of the mean and the median, and then for a specific company in this space, and we say, is this a reasonable thing to do? LTM, by the way, is just last 12 months. So, we can get into details of this separately. And this is an example of a M&A transaction comps. These have been recent M&A transactions in the healthcare technology space. These have been the enterprise value of those transactions, and these have been the EV by revenue, enterprise value by revenue of the of these transactions. So 4.6 is the average, and that probably implies where the current healthcare technology market is probably trading at the end of the day for transactions. So that concludes this presentation, and we'd love to take and answer any questions from here.
Wonderful. And thank you, audience. I did see that there was like an active audience group. They were like kind of exchanging chats and answers. There are like amazing comments that were being kind of orchestrated there. So that is amazing that this is why we have these events. This is that community, the camaraderie that we want to establish, kind of be there for each other and support each other. And one of the things that I wanted to kind of touch upon before, Dhanashree, you can just fire some questions our way. And that was around, Ravi, remember, precedent transaction analysis method that kind of gained so much relevance during the bubble. So at times, which methodology that you pick up is also around the market conditions and the prevailing kind of, I would say, the investor sentiment as well. And now no one literally wants to touch a precedent transaction analysis based approach, because what happened last month or last quarter may not have any kind of relevance in what's going to happen in the next quarter or two, or as of today, what's going to happen tomorrow in terms of tariff or the reciprocal tariff or payback tariff. We just don't know, because those are the external market conditions that we have to just at times wait and watch and wait it out.
So Dhanashree, go for it. Share some questions with us, and I have some really good ones, but the interactions have been amazing, and a lot of the questions have already been answered, but Dhanashree, go for it.
Yeah, definitely. I think we have received a good, overwhelming response for the questions. So let's see. The first question is from Dr. Jacob, I think. Does the equity value already reflect some aspects of depth cash? Is there double counting?
No. So the equity value of a company is simply the product of the share price of a company and the number of shares of a company. That's just as simple as that. It does not account for cash. It does not account for debt, and that's what makes enterprise value almost a more useful metric to use when it comes to transactions, because equity value is simply the value of shares in the company, and that's it.
Got it. Um, I'll move on to the second question from Rajiv Roy. He asks that EV seems to encourage taking on debt and reducing cash. Is that not fundamentally counter to conservative fiscal management?
It's a counterintuitive fact, and it's a good observation, by the way. It's a good question. So enterprise value does obviously go up with debt and does reducing cash, but at the end of the day, what happens is that the when you take on in a financing transaction, when you take on debt, let's say you issue convertible bonds, which I'm sure a lot of people here are familiar with, right? So you issue convertible bonds. Um, when you issue convertible bonds, it means that your debt has gone up by that much amount that you have raised, right? But that means your cash has also gone up at the same time. So they have an offsetting impact, right? So as you increase your debt, your cash goes up because you just raise cash. So it's a financing event. Basically, your enterprise value is not impacted at all at the end of the day, right?
And
So that's kind of counterintuitive.
And more importantly, while EV calculation might appear to you as like penalizing higher cash balances and rewarding debt, it's crucial to understand that context and the way a company is using its capital. While conservative fiscal management focuses on the efficient deployment of debt or cash to generate future value stability, rather than like simply avoiding debt altogether. From an investor standpoint, it becomes very critical to really look at debt and favor debt and reduce cash, because it's all about focus on the total acquisition cost. And maybe debt is used more of a financing source, while cash is potential debt reduction. So that's the reason these two are like fundamentally different, and why it may appear to favor debt and reduce cash.
Yeah, and one thing also I want to point out is that in M&A transactions, in acquisitions, what happens is it's usually done on what's called a zero cash, zero debt basis. And what that means is that when the buyer acquires a company that has some amount of debt and some amount of cash, it becomes the responsibility of the selling company to pay off that debt with whatever means they have, and also means that the selling company can keep the cash on the balance sheet without conveying that to the buyer. So neither the debt nor the cash gets conveyed to the buyer in what's called a net zero debt, zero cash transaction. Just technicalities. But anyway, Bhagyashree, let's keep going.
Awesome. So the third question is by Chris. He mentions that, can we predict the next Netflix and Blockbuster combination?
Abhi, you
Well,
want to take that?
Well, that's the disclaimer that we have had, right? Remember, we cannot give the investment advice. However, it can happen to any company. It can, because the fundamental thing is um, there are this combination of internal and external factors. While we know that Uber and Lyft are going head to head, we get very excited when Uber says that we are going to have, the Uber taxis, like the air taxis, while Lyft has not come up with anything as such. So it's about either you just kind of piggyback on someone else's innovation, or really kind of do something disrupt. So it is very hard to kind of comment, and we would like to refrain from anything to any kind of prediction that impacts as such. Remember what happened when Jensen Huang said that, oh, we are far away from quantum computing and quantum technologies to be like productionized and main scale. The next day, all this stock, atom computing, Rigetti, just every one of them tanked just because of his one statement. So while it is very critical to watch and very crucial to watch their quarter over quarter performance and then see what lies ahead, so that might be the best indicator for those the competitors to kind of see either perform or perish.
Great. Moving on to the next question asked by Abhi. Can you show us applications of these principles to say TikTok? How would they value its US operations given the circumstances?
Some amazing questions there, Ravi. Why don't you pick that up?
TikTok, valuing TikTok. Well, TikTok's an interesting one, and most social media companies are interesting in terms of like how you look at valuation. So it's not atypical to value a social media company based on value per user or the number of users, number of eyeballs that are hitting, and number of subscribers and so on, right? It's not unusual to do that. And that would be a sort of a non-revenue or non-earnings based valuation analysis. At the end of the day, somebody I think made the comment that valuation is in the eye of the beholder. It's anybody's guess as to how fast TikTok is going to grow in its revenues. I'm sure it's growing pretty fast. Given the fact that Gen Z and Gen Alpha, seem to live on it these days. So I think it's an eye of the beholder, and you're going to find if you were to put TikTok on the market today, hire an investment banker and try to sell TikTok, the term sheets that you're going to get for that business is going to have a very broad range, right? And that's something that is fairly typical for a business where the valuation is not entirely obvious, where you're going to use like different metrics and different methodologies to value the business.
Plus, then there are those, what is the rationale as to why this is happening? You have to kind of get to the core. You have to understand that there will be those regulatory scrutinies that led to this national security concerns, thereby this divestment constraints. So everything has that chain reaction mentality. But at the end of the day, imagine a company for which you're not going to get the entirety of its user base, and we don't even know what is the future of the algorithm. Will that be part of the deal or not? Because that was the value and premium on this advertising revenue, which was associated to the algorithm. And if the algorithm is not included, then how would it impact any new or kind of a licensed algorithm inclusion? So it's really kind of not one aspect of it. There are many parts of the deal that's going to really kind of impact how it is valued, not only just at the point of sale, but also the sustenance forward.
Yeah.
And I was also looking at the time, Ravi, please.
I just want to add one more point
Yeah.
to the TikTok thing. So TikTok is widely recognized to have absolutely the best algorithm for presenting content to subscribers. Way better than X, way better than Meta and everybody else. And it is addictive. The algorithm is so good that it is addictive. And that's what a buyer is going to really pay for. If it's a social media company that's going to buy TikTok, they're going to pay a very high price for that algorithm for feeding content, right, more than anything else, right? So anyway, I'll leave it at that. More questions?
Yeah, dopamine overdose.
Yeah, exactly.
Maybe we can take one more question, Ravi, in the interest of time, and then probably say.
Unless you guys want to keep going, I mean, happy to to keep going and respond.
I know Priyank had to say something, and then probably we can just kind of, I will just follow what the captain says, maybe.
Yep.
No, I think there are some really good questions, and Dhanashri is moderating it. So, Dhanashri, do you want to continue? Let's see.
Yeah, we can take one last question and then maybe like just one more. So this and another one, I think.
Okay,
Yeah, just make
Because they
sure
fall
that.
into the similar kind of bucket.
sure.
Yeah.
Like
Okay, that's
us.
good. Yeah, that's what I was meaning to say, that if you see several question in a similar flavor, then you can just lump them.
Yeah, sure. So the next question is about Tesla. So combining multiple questions here. So it was about, why is Tesla enterprise value so high? Is it because of high debt? And also the fact that, Tesla has like a single man risk. So how do you invest in such a scenario?
Great question, by the way. Tesla's debt is actually extremely low. So Tesla's enterprise value is dominated by its market value, and you guys can look that up. You go to Yahoo Finance and put in Tesla and go to statistics, and you'll see that the enterprise value is very close to the to the market value, right? So Tesla operates like a software company. Software companies generally don't have a lot of debt, so it operates somewhat similar to that. So the I think the other question around like key man risk, that's actually a very valid concern, and you've seen that play out in the with the new administration from the point of view that with Mr. Musk being consumed by Doge and the activities there and various other things for the administration, that Tesla shareholders have sort of come out and said that Musk needs to come back to managing Tesla, and there's been some news recently that he is going to leave Doge and he's going to continue to focus on X and on Tesla. So there's definitely a key man risk there, but what I also understand is that Tesla, over a period of time, has built a pretty terrific technology team, a great engineering team, sort of the best of the best in the industry. So if Elon is not going to continue to be part of that organization, it probably will be fine. But the shareholders really sort of predicate future growth and future innovation on the genius of Elon Musk. And if he's gone, then that is lost, similar to what happened after Steve Jobs passed away. So are there any comments on that?
Well, I agree with you. And just to kind of supplement this, Tesla is not an auto company. It's not an automaker. It's a data company to me, the way I view it. And look at the incredible asset that they have developed. Like a comprehensive ecosystem. There are chargers. There are these assets that you have developed, the chargers, the superchargers all around, the network of superchargers that even now Electrify America is wooing them. Can we get our cars kind of be able to charge at your location? So what he has created is that dependency on him, that stickiness. And if there are those elements of stickiness and there are those elements of disruption, that is going to set you apart. And the amount of data that its sensors are catching when a Tesla is driving on the road, the user behaviors, and then kind of looking at the, kind of intertangling with the GPS coordinates. This is phenomenal. This is next gen. So that's why by the time people are catching up to their innovation, they're already kind of way ahead of them, kind of bringing some other feature in the market. So that competitive advantage is something that should be there. But you're absolutely right. Key man risk, if the key man is not focusing on it, is like one man army, as with the Boring Company or SpaceX and others, there will be those deviations from pushing the innovation index.
And I do want to sort of perhaps restate, to be more precise, my earlier statement that Tesla has low debt. Well, in the grand scheme of things, and it's got about probably like $13 billion of debt, but the cash position is much stronger. If you look at sort of, what the debt to equity ratio is, it's still pretty small. It's about, I think, less than 20% if I do the math in my head, right? So that's not very significant. I mean, it's got debt, but not to the point that that's the key value driver for enterprise value. It's really just the value of the earnings and so on, that and then the growth potential, the market potential that is translating into the equity value that's driving the EV.
And the last question, again, combining multiple questions here. So, which method is most suitable for valuing growth phase companies and how to evaluate their quality of earnings?
Growth stage companies. Abhi, you want to take a crack at that?
Oh, wow. I was thinking that the M&A guru should really kind of
I will. I mean, I'll certainly add to what you have to say.
well, there are many ways to kind of compare, kind of my favorite would be to go with the comps and then really kind of look at it because as I said, there are ways to kind of always dismiss that, oh, we cannot compare, contrast, but there are those tonalities of how you are managing the company, the operational excellence, and how conservative you are with the deployment of cash, and at the same time, how you are innovating. So the growth trajectory has happened for a reason, and then kind of how to kind of survive and sustain, are there those elements and factors? So it helps us find those parallels. They may or may not be from the same industry vertical, but at the same time, we have to have a look at the broader scheme of things and ensure that there are those companies that have the similar tenets, and then being able to kind of sort of apple to apple-ish kind of comparison. So that would be my favorite way to go about it. And I don't know, Ravi, what's your thoughts?
Yeah, no, I think that's about right. And people would be tempted to use DCF and do a spreadsheet exercise and do this and that with what is essentially an academic exercise. But at the end of the day, growth stage company, let's say a growth stage company is sort of defined as beyond early stage, maybe a Series B, Series C type company, and with good growth prospects. Those type of companies are almost definitely valued based on the perception of first fundamentally, on what some of the other private companies or other public companies might have received in terms of valuation doing, somewhat similar things. But more importantly, I leave you guys with this message, what we like to call the 3 T's that go into looking at fundamentally the valuation of the company. The first one is traction. So traction is how much has the company been able to penetrate a market, like the customer growth, the customer retention, and so on and so forth. So if those numbers are high, you're going to get a premium valuation. If your net revenue retention is greater than 110%, you're going to get a nice valuation, right? So it's those kind of things. That's the first T, which is attraction. The second T is technology, right? The value of technology is really in the eyes of the buyer at the end of the market. If you truly have outstanding technology, like Tesla, for example, right, or Nvidia, and I'm not saying these companies are going to be sold, but if you're a growth stage company and you have really differentiated technology, there's scarcity in the market for the kind of software or products that you have developed, you're going to get a premium valuation, and you should ask for a premium valuation because of the differentiation. You should compare your business against your peers in the marketplace and demonstrate that you truly have a USP, and that's going to get you a much higher valuation than your comps. The third T is team, right? The quality of your team. Is it a relevant team? Or if, let's say you have 100 people on your FTEs in your company, how many of those 100 people are truly R&D, are truly engineers, software developers, thought leaders, and so on and so forth? Is it 10% or is it 60, 70%? If you've got a team that's full of hardcore engineers, you probably are going to do a lot better than a company with a lot of salespeople, to be honest with you, right? For a buyer, from a buyer standpoint. So the quality of the team, and the scalability of the team. Are these people going to prosper and do well in a larger work environment as opposed to getting stuck with a small business, right? So the scalability of the team is very important. So those are the 3 T's I'll leave you guys with, to end this webinar.
Well, thank you
I
so
think
much
that's
for
it.
all the opportunity. And now we are going to give control back to the awesome IIT SoCal. And thank you, Dhanashree, for keeping us on track and really kind of moderating this. I wanted to thank you on behalf of Ravi and I. So over to you guys.
Yeah, thank you. Same here, Dhanashree. Great job with moderating the Q&A, and also for everyone. This production takes a lot of effort and time. Thank you to Ravi and Abhi for taking time to prepare for it. You probably saw some of the creative videos that Abhi and Ravi came up with the idea. I think that shows about our IIT community. We are smart, we do things differently, and we have a lot of fun doing it. So that's the great experience I had being part of this team in the preparation time. And now that this has all unfolded, it's an amazing session. Thank you, Ravi, Abhi, and Dhanashree, for taking this topic to us. This was your idea, Abhi and Ravi. I think this is a great way to tell to the audience here that this platform of IIT Alumni Southern California is available to all of you as well. If you want to share your knowledge, please do reach out to us. We have different tracks, as Tanashi mentioned. Our audience is very career committed to their career growth. So any topic which is interesting into industry insights or any technology or entrepreneurship related, it is going to value a lot to the audience here. And we know, I mean, that's just like Abhi and Ravi, we have many expert, Tushar and Smita. They came and gave us a great overview of DeepSeek as well. So there are a lot of topics around here. And if you have any feedback for us, please do let us know what you would like to see further in this um, uh, track of entrepreneurship, valuation, finance, so that maybe we can course Ravi and Abhi to come back again with a more fun about around this topic.
And
And
we'll
also,
always welcome feedback on that front, right? I mean,
please,
from the community here, whether it's IIT or non-IIT, if there's specific topics of interest that we should be addressing, I'm sure we can find the right team of experts to be able to talk about that.
absolutely. Thank you. This is really what we want. This is a community that we want to thrive on each other's success, celebrate each other's success, and gain from each other's knowledge, and grow together. And in that spirit, we are also having our future events. One of them is coming up on Saturday, April 26th. It's an in-person event in Irvine. Please do join us. This is specially crafted for people like me and everyone of us who have moved from India to US, and we were very well respected and got a lot of good growth in our earlier years as a technologist. And now when we are trying to break the ceiling to get into the management roles, we are finding some challenges. And there is an executive coach who is very well known in our Southern California community. He is going to talk to us how to rise corporate ladder. And this is going to be an amazing event, very interactive. It's a workshop style, so you're going to take away some great techniques to implement and see if that those work. So this is something that I would highly encourage you to look it up on our website. We have all our events posted there as well. And with this, I would again thank our speakers, Abhi, Ravi, Dhanashree. Thank you so much for all the great work. And thank you all the audience for your time on this Saturday. I know you have many things to do, and you took time to be with us and help us learn together. Thank you, everyone.
Have a good weekend, everyone. Thank you.
Just
Very great.
one last request. Can I give one last request? Can I request everybody to turn on their cameras to just take a snapshot with everybody who is present here, just as a souvenir?
Hey, do we kind of turn off the spotlight, Dhanashree, before that?
I did. Yeah.
Awesome.
I will turn on the gallery view on my end. I would
There you go.
request everybody to turn on the camera and just smile for the camera, please.
Abhi, this smile is not for you. This is for the camera. Just be clear.
Okay, Aparna, Anjay, Puneet. Okay, cool. I'll just take a photo. Just give me 1 second. Okay.
Are you in gallery view, Sri?
Yeah, I have gallery view turned on my
Okay,
end. Don't
cool.
worry about it. Okay, 3, 2, 1. Cheers. Thank you so much. Thank you so
That's it.
much.
We walked into Hall of Fame. Have a good day, guys. Bye-bye.
And
Thank
the
you.
best
Bye-bye.
smile award goes to Tushar Khan.
Thank you, sir.
Always, always.
Thank
Thank
you,
you,
everybody.
everyone.
Bye, everyone.
Good evening.